trade as the market is currently trading. It has just opened. It's 4 o'clock here. So New York Times is now, we're 6 hours off New York Times, right? Seven, but not this week. New York moved 1 hour off summertime and we haven't yet. All right, so usually it's 7, but for these 2 or 3 weeks, the difference is only 6 hours. All right, let's plug in the USD and see what the USD is doing. So plug in USD. You can also try the button F11, which will maximize the screen also. F11. Alright, so much better now. So what you're seeing here is dollar falling tremendously. What is the fall? We're talking about roughly from 77 to 71. This is roughly what? 6 units on a 70 basis. Dollar has fallen roughly 10%, closer to 9% in roughly 1 month. So 1 month fall 10% for any currency, it accounts for a currency crash or a currency collapse. Of course, we have a word for it. It's called a slow motion crash. I mean, it was slow, it was steady. Each day wasn't dramatic or as dramatic as we had it last week when we were discussing it here, but nevertheless it's slow and steady. Now you see this kind of like long handle here and then a little bit up move. Very likely this would be a meaningful bottom. You also see very oversold condition here. You also see that this is getting very deep low here. So there is a decent chance that yesterday was the short-term or possibly the intermediate bottom. What's the expectation? The expectation is a recovery to 75 for a somewhat short-term recovery, maybe 74. For an intermediate recovery, usually the dollar has been recovering midway through the 50-day and the 200-day moving average. So recovery around 76, 77 area is possible within the next 2 or 3 months, as long as we forget, the issue of denominating, right? Then, it's going to be back on the way down. All right, let's move on. Let's try gold and see what gold was doing. More interesting is to see what silver was doing. So gold, you see, it still keeps moving. It is trying. Well, these here lines suggested that every time gold goes up, by the end of the trading day, it gets hammered. In other words, gold manipulators, and you guys should read all Gatta's work, gata.org, which is Gold Antitrust Committee, which explains the gory details of exactly how the gold cartel. Who's the gold cartel? Well, these are those financial institutions that have an inherent interest that the price of gold does not rise. Well, why wouldn't they want it to rise? Well, because gold price is like a barometer to the health of the financial system. So, if they suppress artificially hammer gold price, they would kind of like break the indicator. It's kind of like you have a thermometer and they're playing or fiddling with the thermometer. If possible, they'd rather just break and smash the thermometer altogether so that you don't guys see that it's terribly cold, all right? Or terribly hot, whatever it is. So what this is indicating here is gold runs up $30 from 1,000 to 1,030. And then, at the end of the trading day, it just gets hammered so that it does not close above 1,000. Then, the next day again, it runs up. They smash it roughly $40. That's the day range. And then, gold springs back again, currently at 1,004. Now, this indicates, this is called here a wide ranging day, and a wide ranging day is nothing more or less than increased volatility. And increased volatility is usually or typically indicative of a reversal pattern. In other words, during major, meaning short-term, possibly intermediate, but especially long-term tops or bottoms, the volatility of the market radically, and I mean radically, increases both on the way up and on the way down. It is most pronounced. Well, let's try first silver, and then you will see how pronounced this volatility is in crude oil. Now, for silver, since the beginning of March, we call this appropriately high-level consolidation. So, from 19.5 to 21 or 21.5, it has been steadily consolidating. What is the consolidation doing? Well, number one, it is working off overbought conditions, so it's getting back to normal. In other words, it is preparing for the next run. Number two, it's pulling upward the 50-day moving average, because 50-day moving average provides a stronger support. It is also pulling upward the 200-day moving average, although it's moving a little bit slower. So, there is a good chance that silver will be working off even possibly for another month, maybe for a month and a half. Now, the way picture looks today, of course I may be wrong, it's called speculation, is that dollar, with this wide volatility of the dollar itself, and at the same time with the wide volatility of gold, and notice, wide volatility of silver from less than 20 to 21.5. $1.50 volatility of silver. So with this extreme level volatility, you'd expect a meaningful bottom in the dollar and a meaningful top, or at least a lengthier consolidation here. Let's try WTIC, which is crude oil, and see what happens there. You'll see phenomenal, unheard of volatility. See the last 2 days, from 110 all the way down to 102. So, again, the financial powers have inherent interest to hammer oil as much as possible. Why? Because oil is the second best currency today. It is indicator of future inflation, just like gold. Of course, it is a lot harder to manipulate oil than gold. The reason is that everyone is eager to buy oil, and they don't have a problem with paying a little higher price. Gold is a lot easier to manipulate for a completely different reason. The liquidity of the market is smaller. Of course, gold market is so far a whole lot smaller than the oil market in terms of volumes, in terms of size, but also central banks have substantial amount of gold inventories which they can throw at the market to manipulate it. Well, excuse me, governments have little extra crude oil that they can throw on the market. It's called Strategic Petroleum Reserve, SPR. This is what the US has, and it's tiny. It is tiny relative to the oil market. They can throw a big chunk of it on the oil market. The oil market, meaning the Chinese, are just going to be buying up and say, thank you guys, do you have some more? You know, we're going to buy it all. We'd love to pay you back with your own green pieces of paper and get the real thing, meaning the oil or the gold. So the point is that it is extremely hard to manipulate the crude oil market, but relatively easy to manipulate the gold market. And despite the easiness to manipulate the gold market, they have been able to manipulate it short-term, but long-term impossible. Meaning, if they were able to keep it suppressed, meaning the gold price would not have gone from bottoming in 250 all the way to 1,004 today. They would not have allowed it to go up 4 times. So, phenomenal volatility here, but oil is apparently extremely strong. It springs back from 105 to close to 1010. So it is up roughly, what is it, 450. So no matter how much you try to smash it, next day it's coming back up, and probably, you know, Hong Kong, God knows, Singapore and China would be happy to buy it all up at the much cheaper price. So what else do we have? Let's take a look at the TMX. That will be the interest rate. You might as well get, well, it's not coming up, it's dropped down. So what you're seeing here is now, this is the big multi-trillion-dollar question. Is the yield going to break below 33, which is 3.3% yield, and invalidate this island reversal, or is the island reversal going to hold? See how perfect the very bottom here is with this bottom here. So it may hold, it may not hold. Most of the economists would think and would believe that this would be or this was the meaningful bottom. The test here failed, and this bottom will hold. Then again, if most economists would believe so, the contrarian thinking would be, well, they're probably all wrong, because by definition, the majority of economists are typically wrong and typically get it wrong, all right? You got to be looking at the small contrarian community if you really want to get the right feeling for what's going on in the markets. Well, let's try Dow Jones Industrial Average, and I'm going to show you an example of confirmation versus divergence today. Dow Jones Industrial Average, IA, all right? And see what happens. So, this was here, 11.6 was a meaningful bottom here, meaningful support, or somewhere around here. The market held once, tested and held, tested a second time and held. Remember, this is the 22nd of, what is it, January bottom, and the bottom held in here. Now the market is recovering. This is yesterday's big run-up, is associated with Uncle Ben's interest rate cut. It was like 3/4 of a point. This is a huge interest rate cut, but he's running out of bullets. What does it mean? What does it mean, you know, he's running out of bullets?
Gonna hit zero.
Yeah! If you are, you know, a central banker and current interest rates are 5 and the stick represents 5, you can go to 4, to 3, to 2, to 1. You can shoot at 20, you know, at a quarter point and have 20 bullets, or you can shoot at 1 point and have only 5 bullets. Whatever the case may be, you can hit 0 and then what? Now, keep in mind what's been going on is very interesting. Every time there has been a major, and I mean a major market crisis, Uncle Ben has been the market's savior and has been delivering a generous cut. So, once a cut, a second time's a cut, they have now forced his hand like, what is it, the 4th, 5th time in a row, and quarters have not been enough. He had to move with a half, and had to move once a 75, and now a 75. So he's rapidly, and I mean rapidly, running out of ammunition. Well, the ammunition that he's running rapidly out of is on the short end. The Fed can always manipulate and buy out the long end. If it buys the long end, it means that the TNX that we were looking, the yield could fall even further. In other words, rather than managing the short end, they can start buying out the whole yield curve altogether. And if that's not enough, there are trillions of mortgages, right, to monetize, right? And many of them subprime. So Wall Street would love to unload its mortgages onto the Feds. In other words, to socialize the mortgage risk. So, you see what's going on? Now let's try COMPQ. C-O-M-P-Q. This is the NASDAQ. And watch here 22nd and here how this is holding. This is very interesting. 22nd is a low, and this is probably one of the classic textbook examples of non-confirmation or divergence. In other words, this low here of the 2200 on the NASDAQ, you see that's just the NASDAQ composite, has not held in here. Alright? So, because the trend is low, we can consider that the NASDAQ keeps going down, but Dow Jones is diverging by not making new lower lows. Alright, so that's the one way to think about it. The other way to think about it is, well, the Dow Jones is holding, but the NASDAQ is weak and apparently, not holding. Again, this is time of indecision. We can't just tell. We can't just tell. Is the bottom meaningful and going to hold or not? Again, dollar strengthening. At the same time, gold not rising. At the same time, extreme level of volatility for silver and oil indicates that we may be at a meaningful reversal for, again, commodities, for currencies, and possibly even for the market. Again, hard to tell. In these times, the options are, hey, just stay out of the market, or if you don't want to stay out of the market, just stick it in oil and gold and be safe. All right. So any other market? Oh, the Nikkei, NIKK. Let's take a look at what happened. Kind of like the other day on Monday, the Nikkei got totally and completely devastated. So just take a look at what's been going on. You see, that's Monday. Well, could be. I gotta see the date. But you just see what's been going on. This low here, which was, you see the perfect textbook example, recovering back to the 50-day moving average with a massive drop, another short recovering, massive drop, another one-day recovering, massive drop. So, is it still oversold? Well, not quite. We might expect it to go to 11.5. In other words, another 2 or 3 days of panic selling, and only then we'd expect a meaningful bottom on the Nikkei. Now, the way to look at the Nikkei, if you want to play the Nikkei, you must necessarily be looking at the Japanese yen. So let's take a look at the Japanese yen, which is XJY. X Japanese yen. X Japanese, that's the second from the drop down. Well, that's against gold, it's okay, but just delete the gold, or whichever you want to choose. Alright? So let's take a look at the yen. You see what's been happening? This is a classic example of what could be called an island reversal. A steady uptrend from 92 all the way to 101. That's good 10% run up. 10% run up in what? Roughly 1 month. So a 10% run up for 1 month for a currency is a major run up. Well, it is up against the dollar, so the yen may not have moved an awful lot actually, because it's not that the yen went up, it's that the dollar went down, right? We can also check by, when we look at it against gold to see if yen was up a lot, or look at against the euro. But what you see is that already after a major run up 10%, you suddenly have a skyrocketing yen from 100 to 103 if we look at on this scale. So a 1 day run of 3% is huge for any currency by any world standard. And then this reversal here indicates that this is a meaningful, very likely, a meaningful reversal, especially in overbought condition. And you see the bars here been going up, they have a peak here, and possibly they will slow down. So this one is telling us, hey, the yen is probably exhausting its run-up. So sometimes this is also called an exhaustion gap. So it already have a run-up, and then you have a gap, which is the exhaustion gap.
I have a question about the Nikkei. Is that the index of the Tokyo Stock Exchange?
Yes, that's the index of the Tokyo Stock Exchange, yeah.
as far as
Well, there are like 2 or 3 indices on the Tokyo Stock Exchange. One is more limited, one is broader. Okay?
Tokyo Stock Exchange is only for local companies and they have no more than 30 international companies.
Well, again, sometimes they're called ADR, which at least in the US is when a foreign company trades on a US market. So you may possibly have foreign companies traded on the Japanese market. For example, you can now get, just buy Sony, which is a Japanese company, you can buy it on the US Stock Exchange. So you get the depository receipt. So it's a depository receipt for a stock. It's called ADR. And sure, you could trade. That's not a.
So what is the reason for the fall? Because Americans.
The reason for the fall of what? Of the sky?
The Nikkei.
Oh, well, the reason is that the unwinding of the yen carry trade is perceived by all Japanese, at least all Japanese investors, correctly or incorrectly, that this hurts terribly the Japanese exporters. You got to understand, in Japan as in any other country, the biggest companies which are traded on the exchange are usually internationals, and these internationals make the bulk of their profits and of course their revenues abroad in foreign currencies. So when their currency makes a run, they fear that this will terribly slow their profits and thereby eat away on their profit. So the fear that the rising yen will somehow hurt their exports. I mean, you got to understand that at least for Japanese companies, they're export oriented. I mean, Toyota, Honda, I mean, they are all ex-Sony. They're all, making most of their sales abroad, whether in the U.S. or in Europe. So the reason is that of the fear of the currency hurting foreign exports. This is good now? All right, more questions? What else we had? Well, let's open another tab. I think Control T would open another tab and type in Investor BG. So Investor BG. Just type it up. And let's see what happens with the Bulgarian market. Remember, we were looking at it a while ago. Now, click on one of the charts, straight on the chart, inside the chart. And this is a 3-year chart. So type in, let's say, 1 year. Click on the 1 year to see what happens on a 1-year chart. Well, by the way, you can see 3 days ago, 3 trading days ago, it fell like 3% and it fell like 2%. So, what I was explaining and talking about was, this is the peak, apparently, you have some hesitation, major leg down. It brings in, again, a bear market rally. Again, this bottom holds temporarily, apparently for a day, and then you had a major collapse. Now, if this is mid-January, by the end of March, you see, you have this little bear rally, and then for 1 full month, the market does nothing. Volatility is minimal. If you scroll a little bit down, and we're looking at February, let's scroll a little bit more on February to see if February returns. Not as much. We want to look at February. So, we are looking here at February, see, besides the 3%, you see what's going on. Plus half, minus 1. Plus a quarter, plus 0.7. Minus a little. So, what you see is 2 positive days, small positive, 2 small negative. 2 positive, 2 negative. 2 positive, 1 negative. And all of them are tiner. So, this is called tight trading range. Tight trading range usually presages a large move on the way outside. Could be on the way up, and it will tell to expect a larger move on the way up. But if it falls, it tells us a major fall. So scrolling back to the chart, you can see that, oh, there was one big drop, a second drop, and now a third drop. So now it is looking for a base. It is looking for a support. This one on a 1-year chart looks like a meaningful support level. But from this consolidation, February consolidation, it is, in my opinion, unlikely that it's going to fall just that little and be done with it. That's probably not likely. Probably it's going to fall a lot more. Let's say from 1,400 down to 12 or 1,100. And then try to calm the market. Alright? Now people are not yet scared. They're not liquidating in panic, which tells me the market's got a lot further to go. Any other market you guys want to see, or we get back to our macro fundamental stuff? Any questions? Anybody? No questions. Alright, so let's get back to the macro fundamentals. We were watching this as to how prices are collapsing. Let's move on to the next. Alright, so asset-backed securities, I explained last time, at least I remember, this is where 2004, 2005, and 2006 structured finance takes over Wall Street, and structured finance takes over the GSEs as the primary inflator of credit. So let's move on to the next. Again, asset-backed securities looks like similar in billions. Again, 2004, 5, and 6, the same story. Yeah, click again. You also note that the up and down arrow is also can be used to move up and down. So, what is this 27 billion per month of subprime loan hitting their first resets? So, I think I explained last time about resets. This is what Wall Street has been dreading since 2006. If you would remember, Peter Schiff has been repeating over and over and over again. And in your last, that was the other group, last exam, Doug Nolan has been repeating, hey, these resets will ultimately come. And when they come, people won't be able to pay. And then the whole structured finance thing will be in deep trouble, meaning a loss of confidence with deleveraging and unwinding. So they're giving us what the schedules are for these. Let's move on to the next. Again, asset-backed security growth, it's the same picture, so it's got to be arrowed down. Alright, so not interesting. This is silver versus Dow Jones. Let's move on to the next. Okay, this is the agency mortgage-backed securities. You see 2001, 2, and 3 is the agencies. This is Fannie Mae, Freddie Mac. We call these the GSEs, government-sponsored entities. So they have been the main inflator of the real estate or mortgage bubble. 2004, Wall Street structured finance takes over, and 2005, both are blowing, and of course 2006 is the crescendo of this mortgage bubble before the unwinding begins. There probably will be some other pictures down the road with updates to 2007 and 2008. Again, this is the same MBS growth. Let's move on further. World silver production, not very interesting from a macro perspective unless you're a silver investor. Alright, these are the monthly mortgage rate resets. I think I explained this last time, 2007, 2008, and 2009. You see them by the different categories. You see that the biggest resets are for these green, which green means subprime. That is why everyone was worried about the subprime resets. Well, apparently they were a big chunk, a big percentage of the whole ARM adjustable rate mortgage. So no wonder everyone was getting worried for 2008. What's going to happen? Well, now they don't have to worry about it. They know what happens. You know, they all blow up because people aren't resetting, meaning they are, you know, how did we call it? Jingle mail, right? They just put the keys in the envelope and send them back to the bank. So no one now has to worry about the, for 2 years people worried about the arm resets. And of course, Peter Schiff says, you guys are stupid to worry about it. Why worry about it? Price is going to go up, meaning the payment's going to go up 2 or 3 times. When the payment goes up 10 or 20%, you worry about it. When the payment goes up 2 or 3 times, you don't have to worry. You're sure that they're not going to pay double or triple the price. Well, now what the Fed is going to do with the Treasury is trying to freeze those arm resets. And by freezing it, it's kind of like, this is a terribly sickly person, and we just say, hey, we're going to freeze him, and try to, restore him 20 years from now, hoping that he's going to be in a better health. But by freezing the resets, you aren't fixing anything. The fix is what? The fix is liquidation. Only a liquidation can fix the thing. Alright, so let's move on to the next. Well, these are Asian indices. We were discussing them, and you see the Shanghai moving up. Well, this is the Nifty 50. This is interesting. The Nifty 50 India Index is a wild, and I mean wild bubble from 1,000 all the way to 4,000. This is a phenomenal return. Well, they're probably crashing. I haven't personally been following the Indian market. So far, it is not yet as important, let's say, as the Japanese and of course the Shanghai. Oh, then we forgot to look at the Shanghai market. Do you think we can go back? Yes. No, just click back on the previous tab. Just click on the tab itself. XJY. Yes, that tab. SSEC. Let's take a look at the Shanghai and see what's happening there. Whoa, see, this is a major collapse. So from all the way to 6,000, it is now to 36,000. So it is collapsing. But interesting, over the last 5 days, it has lost like 600 points. On a basis of 42, this is what? Well over 10%. Like a 15% drop in 1 week from 4,200 to 3,600. So this is a classic stock market crash, but again, in slow motion, all right? Because 15% in 1 day will be recognized as such, but in 5 days, they wouldn't really tell you as such, okay? So they say, oh yeah, it's just recovering, they're going to tell you all the stories. So let's get back to the market. So what you're seeing is the Shanghai was one hell of a bubble, and that bubble is, deflating. So let's move on. Asset-backed securities, that seems to be the same picture. I probably stated a whole bunch of times. I remember I was explaining this last time. This is the LTV, loan to value. You see that the only way to get to inflate the bubble was to lend ever more and ever higher percentage of the total value of the asset. In this particular case, is auto finance, is for the cars. So remember that phrase, well, let's join all our hands together and buy an SUV. Remember that phrase? This is a legendary phrase from a great American politician right after the September 11 crisis, where he said, these terrorists are not going to terrorize America, and we're not going to give in, and we're not going to stop shopping. We're a nation of shoppers just because they blew up, 2 towers. No way. Let's join our hands together and go and buy an SUV. Well, how do you buy an SUV in a recession when you don't have money? Well, the answer is they're going to give it all to you. 97% means you have to make a 3% down payment. Well, on a $20,000 car, 3% is like $600. So you put together $600, and then you go and buy a car. You borrow the other 19.4, all right? Or they're just going to give you the discount for it. All right, so when I was buying my Mustang back in the old days, they say, okay, well, we can give you 95% of the value of the car. But Ford, as a graduate student, gave me a $1,500 rebate. So when I signed the deal and everything was fine, I walked in with a brand new Mustang, it's a 98 year, and $1,000 in my pocket. I mean, isn't that a great country? I mean, you walk in a dealer and walk out with $1,000 in a brand new Mustang. Hey, it is, no doubt. I mean, that's where it's coming from. It's coming from they lend you all the money. All right, so let's move on.
Did you pay back?
Pay back the car? Oh, sure I did. I was paying $300 a month. So for while I was a grad student, I was paying down $300 a month. So from roughly $17,000, which was my total with taxes and all, I had paid down in 3 years roughly to $9,000. So when I got my first job in a major corporation, Sterling Commerce, which was part of SBC Communications, and I was getting paid the big bucks, I had a savings rate of close to 50%. So $9,000, I literally saved it in 6 months, and I, paid it all down to zero within my first year of my actual real work. So yes, I did. I mean, it's no problem. Why wouldn't I? I'm not a deadbeat. You know who's a deadbeat? What's a deadbeat? Someone who doesn't pay his loans back or doesn't pay his child support. All right, let's move on. So auto finance companies, loan amounts. This is important chart. Again, what is this telling you? Is, well, 35 months, it tells you that in the 70s, the standard was a 3-year loan, 3-year car loan, all right? And then you suddenly move in the 80s to 48, which is like a 4-year car loan. Well, what does it mean? It means that people couldn't afford 3 years, so they gotta go and stretch to 4, okay? And when they can't pay 4, what do? They move to 55 months, and then the threshold is 60 months. So here's an interesting phenomenon. From 1998 or 9, somewhere from the beginning of the dot-com bust, suddenly the financiers, auto loan makers, those that made the auto loans, had to stretch an extra 10 months the maturity of a car loan just to keep those vehicles moving and out of the parking lots, all right? So the idea is that people had less money, people had less, let's call it discretionary income to pay on a car. So rather than pay, or just because they couldn't pay $400 monthly payment, the lender said, well, you could afford $300, and the borrower says, yeah, and then they say, okay, well, then we can give you a 65 or 62 month loan here in 2003. All right? So essentially, what they did was stretch the overall length or the maturity of the loan, and this implied a lower monthly payment. Now, you're going to be asking, well, what the heck this got to do with macro investing? Well, an awful lot. People are getting deeper into debt. They're getting into a longer maturity debt. The mere fact that it can't pay down in 4 years, but you've got to take 5, has to tell you that they have some fundamental problems with their income. In other words, they can't balance their balance sheet or income statement, and they got to go further, deeper and further into debt. Let's move on. So, commercial banks, financial assets. All right, that's coming from Prudent Bear, so well, the source of the data, of course, is the Federal Reserve Z1 report, but I've copied it from Doug Nolan's website. What you see here is the inflation of the greatest credit bubbles in American history, roughly from 5. These are billions, so 5,000 billions equates to 5 trillion debt in 97. 10 years later, it is, 11 trillion. So what we're looking here is phenomenal, and I mean phenomenal, mind-boggling credit expansion, again, to the tune of extra $6 trillion in credit. And here is the key. This is not the whole credit in the credit system. These are commercial banks' financial assets. Why do these underestimate substantially the overall credit in the system? Because of structured finance. Because Wall Street took a whole bunch of credit, securitized it, put it in SIVs and whatever structures, special purpose vehicles, etc., and moved it off the bank's balance sheet. You see? So if you're actually looking at the blow-off, it is much, much, much steeper because that steepness is hidden by these securities moving off the bank balance sheet. But the point here is that, hey, the credit system is inflating. It is inflating steadily. It is inflating massively. So far, up to including February or whatever, mid-2007, it has no problem whatsoever of inflating. So the other point that Doug Nolan was making, which is very important to understand also in this course as well as in the other, some people correctly noted on their exams that they submitted yesterday, is that you should look and focus on the credit in the banking system or in the whole financial system and not on the monetary aggregates. M1 or narrow money supply might be growing a little or not growing at all. M2 might have a very slow growth, and at the same time you may be in a blow-off credit expansion where credit grows at 10 or 15%, and therefore you have a wild credit expansion which is not supported by narrow money. Well, what does it mean? The correct interpretation again from Doug Nolan is that the Fed has lost control of monetary policy. In other words, credit is part of the money supply, in general the purchasing power, but because narrow money isn't growing much, meaning the monetary base isn't growing, but the overall credit system is rapidly ballooning, this means that the Fed has lost control. They control the base, but the credit system is doing its own thing without consideration for the Fed's monetary base. Well, is that dangerous? Of course it is dangerous, but I'm not going to get it in this course why it is dangerous. The point to take home is that even though monetary aggregates aren't growing, credit is, and therefore you will be misled and you will be making a mistake in your investment financial macro analysis if you're just simply looking at some monetary aggregate, as it will tell you the wrong story. Actually, it will mislead you. Well, M3 would tell a lot nicer story. M3 is rapidly growing while M1 and M2 are growing very slowly. But M3 was exactly for that reason completely discontinued, so that people can't see. You know, they just say M3 is irrelevant, and it costs money, right? To create it. It costs a grad student, 5 hours a week to compile it, but they say, oh, it costs a lot of money. Let's move on. All right. This is Ben Bernanke action figure. So, all of you who are fans of Ben Bernanke, this is the action figure. Now you can drop money out of a helicopter figure. So, you see, man, this is, of course, the bag with money that he's dropping from the... again, warning, cannot really prevent a severe recession. Again, this is one of those Wall Street and mainstream economic beliefs that by just printing more money and by just pumping up a little bit more the monetary system, you can effectively prevent it. The most amazing part, of course, is that we know the lesson, we know the result. 1970s, unequivocally showed that you can't just pump up some more and take care of the problem. Well, it only exacerbates the problem. I mean, that was the demise of the whole Keynesian school, right? Keynesian school was again bankrupt. They had to now rename themselves as New Keynesians, right? So, but the point is that no, that was like 30 years ago. Who the hell studies history anymore, right? You know, plus, you know, they don't want you to understand history because you get to see that, you know, this whole fallacy. If you could print just more, what happens, right? Ben Bernanke better go to Zimbabwe. All right, let's move on. All right, so this is birth-death adjustment. You guys know what's the birth-death adjustment? So birth-death stuff, you know, any of that? Huh? Anybody? Bonuses? All right, this refers to jobs. This refers to how the government computes jobs. This refers to the business cycle as at the bottom and early cycle, businesses will be creating new businesses called, you know, birth of businesses. And then at the end of the cycle, when the cycle is stopping, you will be having more businesses dying, which the government surveys will not be picking up. So what the government would be doing is effectively adjust for the phase or stage in the cycle of how many new businesses are born and how many die, meaning go bankrupt or just shut down, and they adjust employment numbers for this birth-death model. Well, everybody loves this model. Why? What's so great about the model? Well, it delivers exactly the results that you want. You want this result, you put in this assumption. You want that result, you put that assumption. So, we want to create, you know, market created, we surveyed 65,000 jobs, and we got a report 150. No problem, the birth-death model will add 75,000 jobs. Again, piece of cake. You see, so what the model does is the perfect tool to manipulate job data as much as you want. And that's what it's used for. Now, this is the birth month adjustments, the percentage of 12 months. So this is in private, non-farm payrolls. So this excludes agriculture because of its own seasonality, and it also excludes government jobs, because government can always create, you know, hire 10,000 security guards and 50,000 librarians, no big deal, all right? So you want to exclude those. And you see what's been happening. So essentially what the government is doing is from all the way from 2004 to 2007, the government is artificially pumping up the employment numbers so as to keep the unemployment number and the unemployment picture rosy. So what you're seeing here is that since early 2006, the government had to create ever more non-existent, I mean, these are, you gotta understand, fictitious jobs. They don't exist. They are the fiction of a model. And the government, and this is a government model, and the government bureaucrat puts the assumption in the model and cranks out or spits out the answer. So, essentially, the better way to think about it is you always got to look at these non-farm payrolls, the birth-death adjustment, and preferably subtract it from the current labor or non-farm payrolls to get a much more realistic picture. So currently, economists keep analyzing the markets and they say, oh, the job markets was a great number. Well, 1 or 2 months ago it was dismal, even with these huge boosts. But back they were saying, oh, the job market is fine, everything's great, especially in mid-2007. We got nothing to worry about, but no one was saying that the government had to add artificially more and more jobs just to, to keep the picture rosy. All right? So let's move. Is this guys clear? Does it make sense? Is it logical? Well, you wouldn't believe the government will manipulate the numbers. Well, of course they manipulate all numbers whenever they can. Well, whenever it will be to their benefit. You gotta understand, the correct assumption in macro analysis is that the numbers are always bogus, and it is left to you to prove that the numbers are correct, and to prove that the numbers have not been fudged by the government somehow, because the government doesn't have inherent interest to do so, meaning political interest to do so. So there is no more political number. The two big political numbers are employment and inflation. So these are, of course, the most manipulated. Alright, so this is Bank of England repurchase rate target. So this simply shows the monetary policy of Bank of England. It simply tells you that in 2005 it was standing at 450, and the Bank of England had to make 1, 2, 3, 4, 5 interest rate hikes. We call these interest rate hikes at 25 points. What is the name? How do we call these 25 points? Yeah, how do we call the quarter points? What's that Nolan calling them? Baby steps. Baby steps. Remember why the Fed must raise, or Bank of England must raise at baby steps. Because with the extreme leveraging in the markets, any surprise will usually upset the markets to the point of collapse. So they must, number one, telegraph way in advance that they're going to be raising. Second, they must telegraph exactly how much they're going to raise. Give all players in the market the ability to hedge, leave positions and all this kind of stuff. And essentially, this telegraphing means that the Fed keeps constant, the central bank keeps constantly behind the curve. But nevertheless, this increases nominal from 450 to 575, essentially popped the real estate bubble in Great Britain. Real estate prices have collapsed everywhere in Great Britain except for London. Yet, because London up until recently was making big profit, well, recently until the credit crunch. Now that the credit crunch is in full swing and engulfing the British financial system, very likely even London real estate prices will begin falling and falling rapidly. That's pretty much the expectation for 2008. So let's move on and see what's next. Alright, this is European Central Bank monetizes high oil prices. This is coming from, this chart is coming from Gary Dorsch, great economist and thinker about time. Well, let's call him different. Great market analyst today. He publishes regularly on Financial Sense. He specializes in what is called intermarket analysis. Well, what I've been doing and touching all along this course is, again, trying to do some intermarket analysis. My philosophical perspective is, you can't just look at, 5 or 6 profit quarters, the profits in 5-6 quarters of a home builder and conclude that the home builder is a great buy when the next month or the next quarter, real estate market is collapsing, and therefore the home builder will himself go bankrupt. All right, so you got to be looking at a lot bigger picture, meaning you got to look at all markets at the same time. You got to be ready and prepared to look at and make an intermarket analysis, and only then you're on the safe ground. Well, Gary Dorsch is one of those guys who does this job brilliantly today. So what he's showing us here is the price of Brent crude oil. Brent is coming out of the North Sea. This is euros per barrel. So this is the price in euro. And you got the euro price here. And then you have European monetary growth. Remember a couple of, early in the course when I was telling you that the ECB is also busy following Bernanke's footsteps and printing fast. Well, you can see exactly how fast, and you can see the acceleration of the printing press. Barely here in 2004, they were printing like 5% rate, which is fine. And again, from the other course, when they're printing at 5 or 6% and the European economies are growing well, gold isn't rising in euro terms. Once the ECB accelerated to 8.5, you know that gold is going to tell you something's wrong. Well, what is wrong actually is that the ECB is cranking up the printing presses, 8.5% here. Then in 2007, the printing presses ran at 10% already. No wonder that gold's been running up and even faster than 10%. Why would the gold run even faster than 10%? If they just printed 10%, why would gold go even higher than that? Yes, expectations of what? Yes, well, expectations of acceleration of money supply. So, if they print at 10 and gold goes up at 15 or 20, gold is expecting that they will only be printing ever faster. Well, they accelerated to 12, 13, now is the latest number is roughly 13%. So the ECB is also cranking up the printing press. Oh, interesting. Remember we were talking about, when you were recording asking me, well, but the inflation rate in Europe was 2%. Remember that? When you were asking me, now we're having a faculty meeting, so the discussion goes that, well, we got to be looking at different inflation rates. Inflation in Bulgaria is 1%, inflation in Europe is different, and somebody else threw in inflation in Europe was lowest, so those that are living and spending in Europe might be compensating less. And one of our faculty professors was extremely unhappy and said, no way, the European inflation is like 10%. I mean, he's coming from Western European country. So, no, I'm joking the guy, and kind of pulling his arm and saying, no, inflation is only 2%, right? And he says, no, inflation is like 10%. You have no idea. Well, I do, but you have no idea. Prices are skyrocketing in all Western Europe. So, you ask people, especially non-economists, they're going to tell you, yeah, prices are rising by an average of 10%. Even though the reported inflation is 2%. Well, where is the firepower coming from? Meaning, where is the fuel to rise at 10%? Right there. Do I believe? Sure I do. I'd expect, well, for last year, for 2006 and 7, if the ECB is cranking the press at 10%, I'd expect real estate prices to be growing at 15% and consumer prices to be growing roughly at 7 or 8%. In other words, I'd expect real estate prices to grow a little faster and consumer prices a little lower. Well, now real estate is cooling. What does it mean? It means real estate is not growing at this 13% rate. And if real estate is growing at a lower speed than the money supply, then I would expect that something else has got to be growing at a faster speed. Well, what that something else is certainly not the stock market, so it's got to be consumers, consumer goods, bread, oil, milk, whatever. Wheat, right, oil. So what this is telling us is, hey, this rise in the price of oil is simply a mere consequence of the ECB printing money. So from his point of view, this is the logic saying, hey, it shouldn't surprise us and it shouldn't surprise you. The correlation is clear. All right, let's move on. So, growth in broker-dealer financial assets. All right, so who are those broker-dealers? Well, these are, from the way I understand them, the primary brokers or the primary dealers, which we were discussing in the other course. These are the 20 or so companies which handle government securities. So what you see here is you got a, let's say, 93, 94 crisis, and their growth is negative. You have the September 11 crisis and the recession. You got it strongly negative. What you have here is the growth is, look at this, 700 billion in just 2006. All right. So what this is telling you, that these broker dealers' financial assets are bloating their balance sheet. So they must be also a big part of the whole inflation picture. So you got on the one hand those structures, SIVs. On the other hand, you got those, let's say, hedge funds, etc. And then you have these broker dealers. Anyone know a recent, broker dealer? Anybody? Any broker dealer? One name? Come on, guys. Bear Stearns. You got this kind of wild growth in financial assets and therefore of financial liabilities. You know someone's going to blow up. Well, that would be Bear Stearns. Now, did you guys read that there is that theory in the air about Lehman Brothers? Well, now, I sent you the article, at least for some of you. Now, what is the instruction? All of Wall Street is saying, you guys cannot possibly talk about Lehman Brothers. You cannot say to any clients that they got any problems, and you must keep the confidence at all times. All right, so this is what's called the calm before the storm, because there's going to become something else. It's going to upset the market, and all it's going to take is just a couple of hours of a bank run on Lehman to bankrupt it. All right, again, they can't withstand a full day of redemptions. Remember what they were talking on the video in the other course? You got a fund or somebody else, a commercial bank that has, with a primary dealer, it has a $2 billion deposit. Again, what was their balance sheet? Only the balance sheet of Bear Stearns. It was like $400 billion of assets, all right? So 380 at some point of liabilities. So all it takes is one bank pull out 2 billion, another bank pull out 3 billion. The problem with a bank run back in the old days was that you got like 500 people lining up, and a clerk takes 15 minutes to serve the first customer, give him back the money, 15 minutes for the next, 15 minutes for the third, 15 minutes for the fourth. They serve like 30 people and say, okay, time to go home. We can give you the money back tomorrow. Well, that was the old time bank run. So you got to wait for 2 or 3 days to get your money. Of course, the bank will run out by the end of the day. In modern day era, all you do is an electronic entry of withdraw 2 billion, withdraw 500 million. So in 1 hour, you can easily get 5, 10, 50, or even 100 billion of withdrawals. You see? So the electronics kind of works both ways. So in 1 hour, it could swiftly be bankrupt. All right? So this is what you got to understand in these days. Usually it means that by the time you understand that something happened, it is already bankrupt. Well, what is driving it is this growth. Now, this is only the growth. You got to understand, these are not their assets. If they had, let's say, 6 trillion on the asset side, now they have 6.6 trillion by the end of next year. Well, this manic expansion, again, as was the case with Bear Stearns, they abused for some other time. Is it time? Over? All right, let's note we're at broker-dealer growth for next time, and we'll continue next time.